Welcome to StockStream's Investor Education Series. This presentation is brought to you by StockStream Financial Services in collaboration with MyStockStream.com. Today, we will look at the basics of technical analysis. Trading inherently is risky and may not be suitable for all investors. Therefore, we recommend that you treat the contents of this presentation strictly as educational and informational in nature. Our goal at StockStream Education is to increase the awareness level of investors. We propose that you learn concepts of analysis using StockStream's education's training material. Then, follow StockStream experts at MyStockStream.com to see the techniques you have learned being applied to live markets. Once you are more comfortable with a particular technique, we recommend that you conduct your own analysis, get it reviewed by a StockStream expert, and then put it to trade in live markets. Another trading strategy is moving averages. This indicator is calculated by taking the average of the closing market prices for a specified period of time. For example, a 100-day moving average is calculated by taking the average of the closing prices for 100 previous trading sessions. A simple moving average gives equal weights to all the included prices, whereas an exponential moving average assigns higher weights to more recent prices. You can think of moving averages as dynamic support and resistance levels for trading purposes. The important moving averages to consider while trading are the 200-period SMA, 100-period SMA, 55-period SMA, 21-period SMA, and the 10-period EMA. The 200-period SMA determines the market bias. If the market is trading above its 200-day SMA, it is considered to be in an uptrend, and vice versa. The 100, 55, and 21-day SMAs are shorter period moving averages, and thus are more sensitive to price changes. The 10-day EMA is very well respected in strong trending markets. The trading strategy for this indicator involves buying reversal after retest of a moving average in an uptrend, and vice versa. We will look at more trading strategies like crossovers in more advanced lessons. Let's look at an example of moving averages. The first step in developing a trading strategy using moving averages is to determine the market bias. By looking at the chart on the right, you can see the market is making a series of higher lows and higher highs, and is therefore in an uptrend. We will be looking for buying opportunities in these markets. Next, we will use a moving average to determine a buying strategy. The market is in a strong uptrend in the region shown. Therefore, we will use a 10-day EMA to enter long trades. We can see that the market bounces multiple times after testing the 10-day EMA. In each of these cases, we can go long with stops below the lows for the reversal, and hold the position until we close below the 10-day EMA. Bollinger Bands are formed by using a simple moving average and drawing a plus or minus 2 standard deviations around it. The standard deviation curves around the actual prices are called the Bollinger Bands. The 20-period moving average is the default setting used to calculate Bollinger Bands. The trading strategy for this indicator involves selling the test of the upper Bollinger Band in case of a downtrend, or buying the test of the lower Bollinger Band in case of an uptrend. The first step in developing a trading strategy using Bollinger Bands is to determine the market bias. By looking at the chart on the right, you can see that the market is making a series of lower lows and lower highs, and is therefore in a downtrend. We will be looking for selling opportunities in this market. Next, we will use Bollinger Bands to determine a selling strategy. We will initiate a short position on confirmation of failure at the upper Bollinger Band. Confirmation can be established using candlestick reversal patterns or other technical indicators. The stops can be placed above the highs of the reversal candle. Profits can be taken when the price approaches the lower Bollinger Band or another technical X signal is generated. MACD is another very powerful and commonly used technical indicator. It stands for Moving Average Convergence Divergence. MACD calculates the difference between two exponential moving averages and compares it with a different exponential moving average to generate trading signals. The line formed by taking the differences of the two exponential moving averages is called the MACD line, while the line formed by the single exponential moving average is called the signal line. A crossover of the signal and the MACD line generates trading signals. In the default setting, MACD uses a 12 and 24 period EMAs to calculate the MACD line, and a 9 period EMA to calculate the signal line. We look for a crossover of the stochastic lines in the oversold region to initiate long entries. The chart on the right shows 3 examples of long trades that were triggered using slow stochastic indicators. The stops for these trades can be placed below the lows formed before the reversal. We will look to book profits when the stochastic indicator lines cross over downside. As you can see, all 3 trades using stochastic indicators were profitable. In general, more than one technical indicator is used in analysis to develop a trading strategy. The first step in developing a trading strategy using MACD is to determine the market bias. By looking at the chart on the right, you can see that the market is making a series of lower lows and lower highs, and is therefore in a downtrend. We will be looking for selling opportunities in this market. Next, we will use a MACD to determine a selling strategy. The MACD consists of the MACD line, the signal line, and a histogram showing the difference between the MACD and signal lines. Negative values on the histogram indicate a downward bias and vice versa. In this example, because we are looking for selling opportunities, we will sell a crossover of the MACD and signal lines that generates negative values on the histogram. The stops for this trade can be placed above the highs formed before the reversal. Profits can be booked when the MACD and signal lines cross over, again to generate positive values on the histogram. Stochastic is another technical indicator that falls under the category of an oscillator. It takes values between 0 to 100, with a value between 0 to 20 indicating oversold conditions, and values between 80 to 100 indicating overbought conditions. There are 2 types of stochastic indicators, slow and fast. The slow stochastic indicator is more reliable compared to the fast stochastic indicator. Crossovers of the stochastic indicator lines in the oversold or the overbought region generates trading signals. Again, the first step in developing a trading strategy using stochastic indicators is to determine the market bias. By looking at the chart on the right, you can see that the market is making a series of higher lows and higher highs, and is therefore in an uptrend. We will be looking for buying opportunities in this market. Next, we will use a slow stochastic indicator to determine a buying strategy. We look for a crossover of the stochastic lines in the oversold region to initiate long entries. The chart on the right shows 3 examples of long trades that were triggered using slow stochastic indicators. The stops for these trades can be placed below the lows formed before the reversal. We will look to book profits when the stochastic indicator lines cross over downside. As you can see, all 3 trades using stochastic indicators were profitable. In general, more than one technical indicator is used in analysis to develop a trading strategy. If you have any questions, visit mystockstream.com and contact us at StockStream Education. You can also contact any of our other experts covering Forex, commodity, or equity markets. We will be more than happy to answer any of your investment-related queries. Thanks for listening to this presentation and have a great day.